Good afternoon, everybody. Welcome to our corporate investing webinar this afternoon. Very happy to have you here. Apologies for the 1 minute delay on our start here. Some technical glitches behind the scenes, but our team is working really hard to take care of that for you. My name is Paul McQueen. I'm the VP of Wealth at Libro, and I'm very happy that you were able to join us this afternoon. On behalf of all of my colleagues at Libro, we're really pleased to present this seminar, and we really believe this is tied in well to our Be Libro statements of growing prosperity in southwestern Ontario, and aligned to how we're going to help our owners overcome the various challenges, investment decisions, and other things that need to be made in their lives. Specifically, today's conversation about our business owners. We could move ahead here, please. Today's conversation is specifically about investing inside a corporation, which can certainly be rewarding, but it can also present its own challenges. The tax on investment income, as most of you on the call would know already, is higher and more complicated with regular business incomes. So today's goals, we're going to look at the benefits of investing. If we can go back one slide, please. The benefits of investing corporately, the tax challenges that can inform portfolio decisions, and where corporate-owned insurance might help. We're very happy to be joined today by Doug Carroll. Doug is a tax and estate specialist with Aviso Wealth, our partner across the country and for many credit unions for our financial services that meet the wealth management needs of those members of our credit unions, owners of Libro, as well as a range of other independent financial organizations. In his role, Doug researches case law, legislation, financial media, in order to prepare support material for financial advisors and their clients. He's had roles in both the life insurance and investment industry, at both the supplier distributor level, and he has hands-on experience running an estate planning law practice. So he's certainly able to offer practical insights in these personal wealth matters. Doug contributes regularly across media, including the Globe and Mail, National Post, B&M Bloomberg, CTV. The list is pretty long, but we're very happy and pleased to have him here today. Doug holds his bachelor's degree in business administration, a law degree with a specialization in taxation. He's a trust and estate practitioner and a certified financial planner. Professional qualification side, Doug gets the greatest satisfaction when people say he actually speaks English when he speaks the law. With that, I'm happy to turn it over to Doug. Just a few housekeeping options that'll come up on the screen here in a moment. Today's presentation is sort of one way in the sense that you can only hear us and only see us. We can't see or hear you. So if you do have questions that come up during the presentation, please feel free to add them into the chat function. I'll do my best to incorporate those into the conversation where it makes sense, and we'll certainly have time at the end for questions. Today's presentation will be recorded and available at libro.ca, along with a number of other recent presentations that we've done. Enough for me. Over to you, Doug.
Okay, thanks, Paul. I'm going to share up my screen so you can see the slides, give you some visuals background of what it is that I'm covering here, and I'll run with it. So thanks for the intro, and thanks everybody for joining in on this session. As Paul mentioned, it is definitely an advanced type of topic for business owners that we're talking here. And I'm going to get into some details about taxation of corporations. I will give you a certain depth of it, but I'll try not to go too far. But of necessity, given that we're talking about what happens with an investment portfolio in a corporation, of necessity, we have to also understand what happens with taxation of business income in the corporation as the groundwork for then moving over and looking at what happens with an investment portfolio. Excuse me. So I've got 8 topics that are on the agenda here. And as I'll take you through these, we are going to start with a conceptual view of what happens with cash generally in a corporation and when it becomes investable, and then how it is then taxed in the corporation, starting with the business income and then flowing through in the conversation to what happens on the passive income. And then I will make some comments about what happens with insurance in corporations, which for people who hadn't dealt with it before, it might sound like what does the insurance have to do with the investment part of things? And in fact, there is it's a very important element that the insurance can play. It does require that there be an insurance need, but then it can serve a definitely useful type of function with the investments. So conceptually then, let me start here, and I've used this visual of a globe of the Earth for a very long time, for years, decades even, of what happens with money in a corporation. You are running a business so that it can generate profit, but in terms of the form of the property that you own, the assets that you own, the core of things is to generate cash. And so at the center of the business operation, the interior of the Earth here, is the cash of the business, which will make its way back and forth into working capital over the shorter term. And then over the longer term, that's going to be used to then buy capital assets, the machinery that is going to run the business that generates the output of the business. So that's all having to do with the movement of the flow of the financial assets within the business. At a point, once you get going very well with the business and it's operating, and the money is not needed all to flow back into the business activity, then you're going to have a position where money can then break the surface. And once it breaks the surface, it then can be investable. And I really do mean can be investable, because you have to be careful about how you invest money when you have a corporation involved. There can be some challenges that you face in investing in the first place. And if you begin investing inside of your operating company, you could limit your alternatives. With selling that business, you could be conceding on other tax issues if you're not careful. But generally what happens as business develops, you have that excess money, you invest inside the corporation, you may very well set up a holding company, which for a variety of purposes can help out with the management of the business and the ownership of the business. And it also can help out with the movement of money into that holding company to be invested at that level. And then beyond that, you can be looking at taking the money out into personal hands, and eventually that's where you're going to spend it. You know that with a lot of businesses, you can use the business assets concurrently for a hybrid business and personal purpose. But truly for buying things for personal purposes, you really do need to get the money out into your personal hands on a current basis, and then also over the longer term, that's the goal of how you're going to harvest out the value of your business, is to take it into your own hands. So let me quickly outline the types of business structures. Again, you being all business people yourselves, having your own businesses, this would be fairly straightforward. The possibilities of how you can own and run a business, running from sole proprietorship, where you alone own the business. You also can work with others, and between you as a partnership, you can generate income and then allocate out to your partners, yourself and your partners, the income of the business to you on a personal level. And the reason why I'm stopping here with the sole proprietorship and the partnership is because with both of those, the income is taxed to you personally. Again, it's totally on the sole proprietorship, or proportionately if you're in a partnership arrangement. But then when we get over to a corporation, we have a very clear distinction between the legal structure that owns and runs the business as a taxable entity, which is the corporation, and then the owners of that corporation, and that is the shareholders. And so we have 2 levels of tax that will apply at the corporate level as the business is being operated, and then when there is a distribution from the corporation out to its owners, the shareholders, there is tax also to be paid on that stage of things. Now, of course, we don't want double tax to apply. So I'm going to take you through some of the considerations of what happens on the rates of tax in just a couple of slides forward. And also, I'm going to give you some explanation of how the corporate tax and the personal taxes are integrated together so that you don't end up with double taxation, although you can have a relatively small amount of additional tax that might apply when you run the income, whether it's the business income or the passive income, the investment portfolio income, when you run that through the corporation. Where it's business income, it's the other benefits of running a corporation are far going to outweigh any of those concerns. Where it's a passive portfolio, you really do have to pay attention. And when I say you have to have an advisor you're working with who has an understanding of these issues so that appropriate recommendations can be made about the types of investments that you would hold inside of a corporation. So let me first deal with the key distinctions between running a corporation versus a sole proprietorship. And I'm leaving out the partnership because I just want to distinguish what happens in terms of corporate taxation as that two-stage through a corporation versus strictly individual taxation. Now, these first grouping of checklist items, and this is not everything, I'm just trying to isolate down to some key points. This first grouping of items is about you running the business. And when you're running a business through a corporation, you have the benefit of a flat tax rate that applies for a corporation. And there are actually two rates. There's the general corporate rate, and then there's a small business rate. And again, I'll give you those numbers and the rationale of the distinction between those in just a moment. So you very much could make use of that rate as a way to be taxed and have more money available to reinvest in the business. So you end up with some deferral of the annual tax on the income if money does not have to be pushed right out to the owner shareholder level and can be recirculated within the business itself. And then, as I was mentioning, and with my globe reference there, where money is no longer needed to go back into operations, then it can break the surface and can go out into personal hands, or it can remain inside the corporation but be invested in an investment portfolio in that corporation, and that can give you more to be invested at the corporate level than what would happen at the personal level, at least at the first stage of things where you're putting together your investment portfolio. And then in terms of a few points about more along the lines of ownership of the business. So that first grouping about operationally what happens with the income that's being generated, and then now about the ownership of the business. When you own a business through a sole proprietorship, you can employ family members or anyone actually, just as you can with a corporation. So that's not a prohibition where you run a sole proprietorship. But in terms of having them owning the business, you can't have them as owners of a sole proprietorship. By definition, it's sole. So if you want to have shared ownership with family members, a corporation is generally the way you're going to go. It can be through a partnership, but a corporation is a clearer way to operate that. When you have the family members owning shares in the corporation, then the future growth, well, the growth and the eventual taxation on that growth out there in the future, if you've set it up properly, will be in the hands of those family members. So that's a positive that can happen in terms of that capital gain not being solely in you or your hands as the founder. The other part is that historically, the income coming from corporation out shareholder could be paid out as a dividend to any and all of the shareholders of the corporation. And so there was a way that you could do some income splitting with family members by directing some of those dividends from the corporation out to those family members. The ability to do that was significantly truncated a few years ago in 2018. When the government of the day, which is the government of today, actually, the Liberal Party at the time, when they were in the majority coming out of 2015, they introduced some rules that caused the tax on the dividends to family members to be taxed at highest tax bracket, and that's called the TOSI rules, or the tax on split income. I'll comment again about that later. I just bring it in here to acknowledge that paying dividends out to family members is something that can be useful, but that there's more challenges involved in setting it up these days and monitoring it than was the case in the past prior to those change in rules in 2018. Now, as I said, I'm going to give you some definitions here, and I'm going to give this in a visual way that hopefully makes it reasonable to digest. We've got two types of taxpayers in our tax system. We have individuals as taxpayers, you and me as natural persons, and then we also have corporations. And then for corporations, I'm going to nest down the definitions of corporations. There are private corporations and there are public corporations. Public corporations are those that have their shares listed on a stock exchange and have all sorts of extra regulatory oversight than what happens with a closely held private corporation. So almost invariably, you would have, at the very least, you would have a private corporation. And in fact, you would usually have the next narrower definition, which is a Canadian-controlled private corporation, or a CCPC. This is one of those acronyms, CCPC, which is used regularly. It's not just something which is only in the accountants and lawyers' lexicon. I think that it's discussed as the characterization quite often with business owners. With a CCPC, you are entitled to get the small business tax rate. In order to be that, a Canadian-controlled private corporation, you cannot be controlled by either public corporations or foreigners, or a combination of those two. So that's there's more to it than that, but that's the main requirement that you have to meet. And if you then meet that requirement, then on your first $500,000 of business income, you are entitled to make use of the small business rate. And I'll show you what the figure is in just a moment, but it definitely is beneficial to get that very low rate, around about 10% across the country. And I'll give you all the figures in just a minute. So there's your CCPC. Now the next narrower definition is a small business corporation. And although people use that term in a generic sense, small business corporation, it actually is a defined term in the Income Tax Act. And what it relates to is your ability to claim the lifetime capital gains exemption when you sell the business. So you have to be first a CCPC, and that's why I keep narrowing these definitions. You have to be a CCPC, and on the date that you sell the shares, either you intentionally sell the shares, or there's a deemed sale, a deemed disposition, like on your death, there is a deemed disposition from you over to your estate. So on the date that you sell the shares, no more than 10% of the assets in the corporation can be in passive income producing, or flipping that over, 90% or more of the assets on the date of sale must be in an active business income producing purpose. And then in the 2 years prior to the date of the sale, on average, 50% of the assets must be devoted towards active business income producing purposes. So sometimes you'll hear about corporations being purified. And what that means is, in anticipation of the sale of the business, the non-active or the passive assets, the passive investments, exceed that 50% requirement. And so steps will be taken to move those assets out of the company, out of the operating company, perhaps by using a holding company or other maneuvers that an accountant lawyer might recommend, so that you meet the 50% requirement in the 2 years prior, and that on the date of sale, you meet the 90-10 requirement as well. So why am I going through all of those definitions when we're talking about passive income? The reason is, if you have an investment portfolio that you invest in at an early stage inside of your operating company, it might grow up significantly in size, and good for you that you've done that. The problem is then that you have some accumulated capital gains that if you try to then move that portfolio from the operating company out into holding company, you're going to have some significant dispositions that will happen, sale of the passive assets, you're going to trigger capital gains. Or on the other side of it, if those are so large, then a potential acquirer of your business who knocked on your door and said, I've got a deal for you, you're going to have to give that a pass to say, no, I can't do that because I can't get it ready in time. Or you could go ahead and sell, but then you might lose out on the capital gains exemption, which is almost $1 million. You see the figure here, $892,000 of capital gains could be protected by the capital gains exemption. So very important that at the point where you see excess money that you are able to invest in the corporation, that you make sure that that you are paying attention to the potential that there's going to be a sale down the road, and that the business activity and the investment activity are coordinated with one another, so that you keep that door open for the capital gains exemption. Okay, so I said I was going to show you the numbers. Here we are. I'm just looking down the line here, about midway along there, middle of the country. We've got Ontario showing, and what you see, I'm doing the comparison here with a top bracket individual whose tax rate is 53.5%, and comparing that to what happens with the small business rate. 12.2% is the small business rate for Ontario. You can see it gets down to 9% in Manitoba, but it's all around 10% across the country. So 12% rate that applies for a person is much better than the 53%. And even if you can get the corporate rate's 26.5%, 26.5%, then a significant difference between what you would pay personally versus either the corporate rate and particularly the small business rate. Now, not everyone is at top bracket, but I can pretty much guarantee you that if you're running a successful business, 12.2% as a rate to run the business is much better than whatever rate you're going to face as an individual. So this is the business income. And the benefit that you have, as I was mentioning early with my my reference of the check boxes, that you can reinvest money in the business, you've got the difference between the rate that applies in the corporation. I'll just focus on the small business column here. You've got about 40% difference that applies, that the money that's generated off the business can be reinvested in that business, where you get the use of the small business rate. And as again, once you get past the point where you have to reinvest the money in the business, or where you don't have to reinvest all of it, then the excess cash, instead of paying that out by dividend, which then means that the second stage of tax applies, and you can see here, you end up with 54%, the total rate that would apply corporation plus you personally take it out of your personal hands. You're still looking at somewhere around a 40% difference from what the corporation is paying in the first place, and how much will be lost to taxes before you can invest if you take it under your personal hands. So if you can leave it inside the corporation and invest it in an informed way, then you can be better off for having done that. So that's what we're trying to work with here. So let me take you through the flow of money coming into a corporation and then paying taxes from the corporation, and the fairly simple graphic that I am going to show you here, and then I'll get just a little bit more detailed, and I really do mean just a little bit, when we look at what happens with an investment portfolio. So with the corporation earning business income, we've got our smokestack operation that's got the income through the business coming to the corporation as the owner of the business, and the corporation then pays tax, corporate tax, so 12.2%, let's say, our Ontario small business rate. And then when the corporation pays the dividends that it has out to the shareholder, so out of retained earnings, pays dividends over to the shareholder then has to pay tax on the dividend. But the arithmetic involved in calculating the tax that the shareholder is paying basically reduces the shareholder's burden of tax by the amount that the corporation has already paid on the income that the corporation earned. So between the two, the shareholder and the corporation, there is a frictionally different amount of tax that might be paid. And as you saw from the previous slide with the numbers on it, if the income had been earned as a sole proprietorship, then the top bracket rate would have been 53.5%. That same person earning business through a corporation and coming out to themselves would pay 54.1%, I think was the 50% and another couple of decimals. So it's not significantly different what the person would pay by having run through the corporation, and you get that significant deferral from the time that the business earns the income before you pay the other side of tax in the personal hands. So this is business income. So the question that then comes up is, what happens with your passive income? How much tax do you pay on passive income? And you do not get the small business rate. In fact, you don't even get the general corporate rate on your passive income. You are charged the tax at the corporate rate, the full corporate rate, and there is an additional investment income tax that is added to your tax rate at the corporate level. And effectively what that's doing through the arithmetic, what it is attempting to do is emulate the corporation as if it was a top tax bracket individual. Even though maybe you as the owner of the business are not a top tax bracket person, maybe you're making a pretty decent income at, let's say, $120,000, and so you're not at 53.5%, you're more in the low 40s. Still, the corporation gets taxed on that passive income at top bracket rate, which includes this additional investment income tax. Now, fortunately, that additional tax is not completely gone. It is put into a calculation to make sure that it actually comes back to the corporation. It's called refundable tax that comes back to the corporation once dividends are paid from the corporation out to the shareholder. So going back to our visual, I'll show you what happens here. We've got the investment portfolio generating its passive income. We have the corporation receiving that income and then paying the tax over to the Canada Revenue Agency, which includes the additional tax. So it includes the refundable tax. In order to get the refundable tax back, the corporation, the owners of the corporation or the directors will cause the corporation to pay dividends out to the shareholders. And when the dividends are paid to the shareholders, then the corporation gets back that excess money that was on deposit with the Canada Revenue Agency. Essentially, if you leave a balance there in your refundable tax, it's non-investable. It doesn't do anything for you. It's just because you're a nice person who wants to give money to the government to have available to it to invest, but not for you. So just be aware that refundable tax that you do not get back into your own hands is inert. It does nothing for you. So we got the dividend coming out to the shareholder, and then similarly to what happens with the dividend that is paid out of business income, the shareholder again is taxable on the dividend coming out, and the calculation of the tax that the shareholder is paying nets out what the corporation has already paid. So once again, we've got the integration of corporate tax and personal tax so that, again, with some frictional difference, you don't pay any more tax because you've run this through a corporation. But with passive income, because of that refundable tax issue, you still have some concerns that you may end up with a significant balance of money that you can't use if you're not careful about how you, one, choose to invest the money that's in your investment portfolio, and two, determine how it is that you're going to pay dividends from the corporation out to you personally. So those developments that I mentioned from 2018, let me highlight these. This one's a little bit more text heavy. I'm going to run you through these points here. So what happened in 2018, what the government was trying to do, again, as it announced in more of a general way during the election campaign in 2015, there was a concern, the party had a concern that the use of corporations was being abused by some wealthy people, and so they were going to take action on this. The original proposals were much more complicated than what actually ended up happening, but nonetheless, it still is a fairly significant difference that applies for business owners now when they have investment portfolios inside their corporation. So one of the dollar figures that people would be familiar with perhaps is the $50,000, $50,000 threshold. If your corporation has more than $50,000 of passive income inside the corporation in a year, then the small business rate threshold, which is 500,000, is brought down. So for every dollar over 50,000, $5 comes off of that small business threshold. And that means that by the time you get to 150 of passive income in your corporation, you then do not have the small business tax rate available to you. All of your income will be subject to the general corporate rate. Now, that's not the world's end. The fact is that you pay the corporate rate, whether it's the small business rate or the general corporate rate, and then when dividends are paid from the corporation out to shareholder, then again, the shareholder pays the difference between what was paid corporately and then what is due from the shareholder. But you would rather pay at the 12% rate than at 26.5% rate on your business income, and that's the implication of this rule. The other part of this, though, that creates more challenge is it used to be that in order to get those refundable taxes back, any dividends pretty much that were paid out of a corporation would recover the refundable tax that was generated off the passive income. So you could have active business activities that allowed for dividends to be paid that would then recover the refundable tax on passive income that was earned, so that you could pretty much keep the investments intact inside the corporation. The rule changes in 2018 pretty much force a shareholder or the business operation overall to pay dividends out of the corporation when passive income is generated in order to get the refundable tax out. So you earn it, it's realized in a year, you're kind of forced to take the dividend out into personal hands. Otherwise, you could have that balance of refundable tax, which is not investable for you. Again, unusable money for you. And then the last point that I want to touch on here is that, as I mentioned, the tax on split income was changed so that back in the 1990s, I believe was the time that this was brought in, the kiddie tax, as it's referred to, was brought in, the tax on split income, that caused dividends that were paid to a minor child related to a business owner, a shareholder. It caused those dividends to be taxed at the highest tax bracket. The rules change in 2018 causes dividends paid to adult children as well as spouse to potentially also be charged the tax on split income. So to be elevated up to top bracket level. So a lot less opportunity to income split with them. If those adult children or the spouse are involved in the business, then you can get around this. It depends on how much they're involved, but if they are actively involved, then maybe there's no concern about tax on split income. But in the meanwhile, if they are merely owners for the convenience of sharing the ownership and they don't participate in any way, then you're not going to be able to dividend out quite